Building upon the previous discussion on due diligence and environmental responsibility in commercial real estate, it is essential to now understand one of the most influential factors in the financial structure of commercial property transactions: the type of lease agreement in place. The lease type defines how income is generated, how expenses are allocated, and how risks are distributed between landlord and tenant. These lease forms, gross, percentage, and net leases, each serve unique purposes depending on the nature of the business, the property type, and the level of management involvement desired by the landlord. A gross lease, sometimes referred to as a full-service lease, is one in which the tenant pays a single rental amount, and the landlord covers all property-related expenses, including taxes, insurance, and maintenance. This type of lease is most commonly found in office buildings, medical complexes, and some multi-tenant commercial centers, where landlords manage all operational costs to ensure consistency in service and property quality. Tenants favor gross leases because they provide predictability. Monthly rent remains stable, and there are no surprise expenses. However, landlords often charge higher base rents to offset their responsibility for these costs. For example, a tenant leasing a suite in a Class A office tower in downtown Phoenix under a gross lease might pay $32 per square foot annually, while the landlord uses part of that rent to cover the building's janitorial services, utilities, and property taxes. In contrast, a net lease shifts some or all of the property's operating expenses to the tenant. There are three main categories of net leases: single net, N, double net, NN, and triple net, NNN. In a single net lease, the tenant pays rent plus property taxes, while the landlord covers insurance and maintenance. A double net lease requires the tenant to pay rent, property taxes, and insurance, leaving maintenance and structural repairs to the landlord. The most common form, the triple net lease, transfers nearly all financial responsibility to the tenant, including taxes, insurance, and maintenance, making the tenant responsible for most expenses associated with the property. Triple net leases are particularly popular in standalone retail properties, such as fast food restaurants, gas stations, or chain pharmacies, where tenants prefer control over their premises and landlords favor a predictable income stream with minimal management obligations. For instance, a national retailer such as Walgreens or Starbucks might sign a 20-year triple net lease where the tenant pays for all property-related costs, and the landlord simply collects rent. This arrangement creates a low-risk, steady investment for the landlord and allows the tenant to maintain brand consistency across multiple locations. The percentage lease, on the other hand, is often used in shopping centers and malls, where tenants pay a base rent plus a percentage of their gross sales. This structure aligns the interests of both landlord and tenant. The landlord benefits from the tenant's success, while the tenant's base rent remains lower during slower sales periods. For example, a small boutique in Scottsdale Fashion Square might pay $3,000 in base rent per month, plus 6% of gross monthly sales exceeding $50,000. The percentage lease incentivizes landlords to maintain high-traffic environments and actively promote the shopping center's success. Each lease type carries distinct implications for expense allocation and risk management. In gross leases, landlords bear the burden of rising operational costs, such as insurance premiums or property tax increases, which may erode profitability over time. Conversely, in net leases, tenants assume these variable costs, offering landlords predictable income and reduced administrative responsibility. Percentage leases balance both parties' interests by allowing income to fluctuate based on business performance, but they require tenants to disclose sales figures and maintain accurate accounting records. Real estate licensees representing clients in commercial lease negotiations must understand these distinctions to properly advise landlords and tenants. The Arizona Administrative Code R4-8-1101K requires agents to recommend that clients seek professional assistance. such as from attorneys, CPAs, or property managers, when lease terms involve complex expense allocations or long-term investment implications. Misunderstanding lease structures can lead to significant financial miscalculations, disputes, or breaches of contract. Arizona courts have reinforced the importance of clear lease agreements in determining the allocation of expenses and responsibilities. The Arizona Court of Appeals ruled that ambiguities in a commercial lease concerning maintenance obligations would be construed against the landlord, who drafted the contract. Mobile Oil Exploration and Producing. Southeast Inc. Gervais, United States. A commercial leaseholder operated on federal land and later discovered that environmental contamination, petroleum, and hazardous waste existed due to prior operations. The lease contained provisions regarding maintenance and environmental responsibilities, but the obligations were not clearly defined regarding who was responsible for remediation of pre-existing contamination. The court emphasized that in commercial leases, parties must clearly define which party is responsible for environmental remediation and associated costs, especially for contamination existing prior to the lease term. Ambiguities in the lease can lead to litigation and allocation disputes under environmental statutes like CERCLA. Review summary. Commercial leases define the financial and operational relationships between landlords and tenants. A gross lease provides simplicity and predictability for tenants, but greater expense responsibility for landlords. A net lease, particularly the triple net form, shifts most expenses to the tenant, reducing the landlord's management burden and ensuring a stable income stream. A percentage lease ties rent to a tenant's sales performance, aligning incentives and encouraging mutual success in retail settings. Real estate professionals must be able to distinguish these lease structures, interpret their implications, and ensure compliance with Arizona's professional standards and disclosure obligations. Discussion prompts. How does a triple net lease differ from a gross lease in terms of risk and expense allocation? Answer. In a triple net lease, tenants pay property taxes, insurance, and maintenance costs, shifting financial risk from the landlord to the tenant. In a gross lease, the landlord covers all property-related expenses. Why might a landlord prefer a percentage lease in a shopping center? Answer. Because the landlord benefits from the tenant's business success through shared sales revenue, incentivizing both parties to maintain high traffic and profitability. What Arizona case emphasized the importance of clearly defining expense obligations in commercial leases? Answer. Dunlap v. Jimmy GMC of Tucson, Inc., 1984, which held that ambiguous lease language regarding maintenance would be construed against the drafting landlord. Closing remarks. Commercial leasing is one of the most financially nuanced areas of Arizona real estate. The type of lease structure determines not only how profits are earned, but also how risks are shared between landlord and tenant. By understanding the distinctions between gross, net, and percentage leases, licensees can guide clients toward arrangements that align with their financial goals and operational needs. Competence in lease analysis demonstrates professionalism, minimizes disputes, and enhances the long-term stability of commercial relationships in Arizona's growing business environment.